Kia ora. Welcome to Where is My Cash series covering inventory. Inventory refers to raw materials, work in progress, finished goods held by a business that is to be sold or used in production. They are current assets on the balance sheet. Inventory does have a value on the balance sheet. They are deemed net realizable value. So this is costs plus logistics, storage, and recoveries, and it's called inventoriable costs. When you're selling inventory, you do want to sell it at a margin. This is to recognize the value add. So whether you are having something additional on top of your product, whether it's a design, or you're converting something from one product to another product, or you're coordinating logistics. So you are planning from your supplier and you're the coordinator from one party to another. Unlocking cash. This is where you need to set your margins right. So between the costs of inventory, catering for the likes of storage, staff costs, rent, variable costs, compared to your list price or RRP. Some companies like to set standard costing of inventory, so it's up to you how you want to look at it, but having an idea of how much it costs to store and how much to sell it for is where all the unlocking of cash comes in. So bear in mind, if your items are perishable, this adds to the pressure of having to sell them by a certain expiry date or use by date. So the likes of greengrocers need to factor in spoilage or wastage. Even if you are drop shipping or buying something from an online vendor, you need to coordinate logistics and duties and customs with it. Technically, it is still classified as inventory, and it is a cash outgoing or commitment. My slide's a little bit funny. So cash cycle for this is why I want this to be the third topic to talk about, because it is tying in accounts receivable, accounts payable, and inventory together. So when you buy stock, this is when you have committed to a supplier, so that ends up being in your accounts payable, that you have 30 days to pay, for example, based on your payment terms. And then let's just say you're a traditional business and stock sits on your shelving for, say, 60 days. Therefore, you must pay the bill before making a sale. Thirdly is the sale has been made. So we're very grateful that you have made the sale. However, you've got a credit of, say, 30 days. Unless you're a digital platform and it's required to pay you up front, but not always. So cash can be tied up in the sense. Or if you're unlucky, no sale yet, but you have inventory tied up, and therefore cash is locked up in inventory. With the prior example, it can take easily 60 days before you are cash neutral. So from the day you purchase to the day that you made the sale or collected the cash. So it is very important to work out your gross margins so that you've got enough of a buffer to wait for this cash neutrality at 60 days. There are some tips and tricks for you as usual. Look at your purchasing costs. So shop around for a good deal. Or I actually like this better, is to commit to a supplier so that you set intention up front, is to say, hey, I do want to work towards a longer term commitment with you, and if possible is that we get better pricing. that usually gives you better outcomes. You do want to be on the pulse with your exchange rates. It helps to really understand what your foreign exchange rates could be or will be. If you have got a person or a dealer, foreign exchange dealer that you deal with, they usually do know, although they're not 100% accurate, everyone's having a crystal ball, right? They can tell you or give you an indication of what that looks like. Otherwise, you can look at what's called hedging. If you want something to talk about hedging, I can talk a little bit about that in following topics. Analyze your market and target audience. I always love this topic about your strategic positioning because it's so interesting to me. Are you competing at premium pricing? So this is all about pricing, right? Premium pricing usually comes with great quality, great service. Average, well, it's kind of middle of the road. Or low pricing, which often means it's not as high quality, but low pricing and high volume, which is how you make your margins. So set your recommended retail price accordingly, and at times you need to be flexible if you actually need to move the goods. So if you have perishable stock, especially, I know some companies that are unwilling to discount or give any credit. However, if you do have something that is going to be perishable, think about discounting or moving it, even if you have a little bit of cash back in is better than nothing. And so lastly, my final few comments. Inventory management is an art rather than a science, even though it's coming from an accountant, I know, but it is, unless you're so stock standard, which I hardly see, because even with stock standard, New Zealand being largely an importer, is actually quite hard to predict the likes of how much is going to be your exchange rates, and the volatility in pricing, especially with inflation and the fuel prices going up. It's actually quite hard to predict how much your pricing should be in landing, but it does come with time. So when you've done multiple iterations, you've looked at your margins, if you analyzed it and you've looked at how much you're making on such and such and how long it takes for you to collect your cash from start to finish, you will get a better inkling of how much you should charge for and how can you actually utilize your inventory to your advantage. So this concludes our working capital elements of our cash conversion cycle, so covering the three engines of AR, AP and inventory. Thanks.